Two numbers came out this week that should be on the front page of every financial newspaper on Earth. The first number is 3.3%. That is the March 2026 Consumer Price Index reading, the highest inflation print since May 2024. The second number is 0.5%. That is the United States GDP growth rate for the fourth quarter of 2025, half the previously estimated rate, and the weakest economic growth reading in years. High inflation, stagnant growth. Those two numbers together have a name, stagflation. And stagflation is not just an uncomfortable economic condition, it is the single most dangerous financial environment that ordinary savers and investors can find themselves in. Because in stagflation, your costs go up and your economy goes down simultaneously. And there is almost nowhere to hide. Almost nowhere. Because there is one asset class that has outperformed in every stagflationary environment in modern history. Every single one, without exception. And right now, in the same week that stagflation became officially confirmed by hard data, a story emerged that makes the case for that asset class more urgent than at any point in the last 50 years. The United States government has essentially zero silver in its strategic stockpile. Not low, not declining, zero. The country that once held the largest silver reserves on Earth, the country that melted strategic stockpile silver to mint coins, to fund defense programs, and to supply industrial users for decades, has run its stockpile down to nothing. And it just declared silver a critical national security mineral. In the same week, stagflation arrived officially. By the end of this video, you will understand exactly what stagflation means for silver, historically and mathematically. You will understand how the United States went from holding hundreds of millions of ounces of strategic silver to essentially nothing, and what that means for the supply picture going forward. And you will understand why the combination of these two stories, told together in context, represents the most compelling case for silver ownership that has existed in the last half-century. Let us start with stagflation, because most people have heard the word, but very few understand the mechanics well enough to know why it is so specifically, so uniquely, so extraordinarily bullish for silver. Stagflation is the combination of stagnant economic growth and persistent inflation occurring simultaneously. In normal economic cycles, these two conditions are mutually exclusive. When the economy grows strongly, inflationary pressure tends to build. When the economy contracts, demand falls and inflation cools. The Federal Reserve manages the tension between these two forces, raising rates to fight inflation, cutting rates to stimulate growth. But stagflation breaks that mechanism entirely. When you have inflation and stagnant growth at the same time, the Federal Reserve faces an impossible choice. Raise rates to fight inflation, and you crush the already weakening economy. Cut rates to stimulate growth, and you pour fuel on inflation. There is no good move. And the Federal Reserve's inability to move cleanly in either direction means that the monetary conditions that suppress precious metals, rising real interest rates, cannot be sustainably maintained. Because rising real interest rates in a stagflationary environment kill the economy before they kill inflation, and no central bank can politically sustain an economy-killing rate policy for long when growth is already at 0.5%. This is the precise dynamic that drove the greatest silver bull market in modern history. In the 1970s, the United States experienced two waves of stagflation, driven first by the 1973 oil shock from the Arab oil embargo, then again by the 1979 Iranian Revolution. Inflation ripped. Growth stagnated. The Fed was trapped, exactly as described above. Silver in 1970 was approximately $1.63 per ounce. Silver in January 1980, at the peak of the stagflationary bull market, touched $49 per ounce. That is a 3,000% gain over a decade driven primarily by stagflationary conditions. 3,000%. Now look at what has just been confirmed in the data this week. March 2026 CPI came in at 3.3%, the highest since May 2024, at a moment when the Federal Reserve had been hoping inflation was on its way back to the 2% target. Goldman Sachs noted that if oil prices even temporarily rise to $100 per barrel, which they have already done in the context of the Iran conflict, global headline inflation could rise by a further 0.7 percentage points, and global growth could slow by 0.4 percentage points. 2025 GDP was revised down to 0.5% annualized, half the previously estimated rate. This revision came before the full impact of the Iran war on energy prices, supply chains, and business confidence had been incorporated. The U.S. economy is growing at 0.5% per year. Inflation is at 3.3% and rising. Goldman Sachs is warning it could go higher. The Federal Reserve is trapped. This is stagflation. Not the forecast of stagflation, not the risk of stagflation, the confirmed, data-backed, hard number reality of stagflation in April 2026. And the silver market has not fully priced it in yet. Here is why. Silver is currently sitting at approximately $75 to $77 per ounce, up from its post-correction lows, but still roughly 35 to 40% below its all-time high of $121 reached just 10 weeks ago. The stagflation confirmation came this week. The silver price has not moved proportionally to reflect what stagflation has historically done to silver prices. In every stagflationary episode in modern history, silver has not just risen, it has exploded. Because stagflation creates a perfect storm for silver on both its monetary and industrial dimensions simultaneously. On the monetary dimension, stagflation destroys the purchasing power of cash and bonds. When inflation is running above the interest rate that savings accounts and bonds pay, every dollar sitting in the bank is losing real value every single day. The incentive to hold monetary metals, gold and silver, as a store of value becomes overwhelming. On the industrial dimension, stagflation driven by energy shocks typically coincides with massive government investment in energy independence, alternative energy, domestic manufacturing, infrastructure, all of which requires silver in quantities that industrial procurement teams cannot easily substitute away from, regardless of price. Silver is the only major asset that benefits from stagflation on both dimensions simultaneously. The monetary demand comes in because cash is being destroyed. The industrial demand comes in because the energy transition that stagflation accelerates requires silver at scale. Both forces are operating right now in April 2026. And both forces are being dramatically amplified by the second story that has emerged this week, the story of America's empty silver stockpile. Because if you want to understand why the silver supply response to this stagflationary demand shock will be slower, smaller, and more painful than any previous precious metals bull market, you need to understand what happened to the United States government's silver reserves. The story begins in World War II. During the war, the United States government accumulated an extraordinary strategic silver stockpile. Silver was critical for the war effort, used in electrical components, ammunition, and most importantly, in the enormous quantities of electrical wiring required for the Manhattan Project, America's nuclear weapons program. With copper being diverted to military use, silver was the only substitute that could conduct electricity at the scale required. By the end of the Second World War, the United States government held approximately 2 billion ounces of silver in its strategic stockpile. 2 billion ounces. At today's prices, that would be worth approximately $150 billion. Over the following decades, that stockpile was gradually drawn down. Congress authorized the sale of strategic silver for coin mintage. The Defense Department used stockpile silver in weapons programs. Industrial users accessed government silver through various authorization programs. By 1971, when Nixon took America off the gold standard, and the monetary system fundamentally changed, the U.S. silver stockpile had already begun its long decline. By the 1980s, it was significantly depleted. By the 2000s, it was nearly gone. And as Mike Maloney and Alan Hibbard of Gold Silver documented in research published last year, research that has since been validated by silver hitting $121 per ounce, the United States strategic silver stockpile is now essentially at zero. Zero. The country that melted 2 billion ounces of silver across 5 decades to fund wars, mint coins, and supply industrial programs has nothing left. And in January 2026, the United States government issued a presidential proclamation invoking national security law specifically to address the country's import reliance on silver. Read that again. The United States government used national security law, the same legal framework used for oil, semiconductors, and rare earth minerals, to address the fact that America depends on imports for its silver supply. This is not a policy paper. This is not a think tank report. This is a presidential proclamation invoking national security authority because the United States government has recognized that it no longer has domestic silver reserves adequate for its strategic needs and is dangerously dependent on foreign supply, particularly from China, which controls 60 to 70% of the world's refined silver supply and has implemented export restrictions that are set to remain through 2027. Let that sink in fully. America's most strategically critical technology metal, used in solar panels, electric vehicles, AI data centers, defense systems, semiconductors, and medical equipment, is controlled primarily by America's primary geopolitical adversary. And America has no strategic reserve left to buffer a supply disruption. This is a national security crisis, being managed behind closed policy language, while most ordinary Americans have no idea it exists. Now let us connect the two stories, stagflation and the empty stockpile, because together they create a supply and demand dynamic that has no historical precedent in the modern silver market. On the demand side of the equation, stagflation is simultaneously creating monetary investment demand and accelerating the industrial demand from the energy transition. Both demand categories are growing simultaneously and structurally. Physical silver investment demand was already projected by the Silver Institute to rise 20% in 2026 to 227 million ounces, a 3-year high. That projection was made before the stagflation data was confirmed this week. With 3.3% inflation officially confirmed, alongside 0.5% GDP growth, investment demand for silver as a monetary store of value is going to be significantly higher than that projection. On the supply side of the equation, the empty U.S. stockpile means there is no government buffer to release into the market when industrial demand spikes. In every previous commodity supply crisis in American history, the government has had strategic reserves it could draw on to moderate price spikes and stabilize industrial supply chains. Oil crisis? Release from the Strategic Petroleum Reserve. Rare earth shortage? Draw on strategic stockpile. For silver in 2026, there is nothing to release. The stockpile is gone. Which means any demand shock, whether from stagflation-driven investment buying, industrial acceleration, government procurement for defense or energy programs, or a physical delivery squeeze on the COMEX, has to be met entirely by current mine production and existing above-ground private stocks. And mine production is not responding to higher prices. Fresnillo, the world's largest primary silver producer, just cut its 2026 production guidance. Major silver mines take 7 to 15 years from discovery to production. The cumulative supply deficit across consecutive years has now reached nearly 820 million ounces. The buffer is gone. The stockpile is gone. Mine supply is constrained. The deficit is 820 million ounces and growing. Stagflation just arrived officially, and China controls 60 to 70% of refined global supply while restricting exports. This is what an asymmetric supply shock looks like in the early stages. The silver market has been in a structural deficit for 6 consecutive years. The price correction from $121 to the current mid-70s was driven by paper market dynamics, margin calls, leveraged position unwinding, Iran war rate dynamics. None of those factors changed the physical reality. None of them refilled the U.S. strategic stockpile. None of them produced a single additional ounce of new mine supply. The physical reality is more strained today than it was when silver hit $121. And the macro environment just got dramatically more bullish with the official confirmation of stagflation. Now let me bring the historical parallel into focus one final time, because this is where the magnitude of the current opportunity becomes undeniable. In the 1970s stagflationary episode, silver went from approximately $1.63 to $49 over 10 years, a 3,000% gain. But in the 1970s, the United States still had a meaningful silver stockpile. Global industrial demand for silver was a fraction of what it is today. There were no solar panels, no electric vehicles, no AI data centers, no smartphones consuming silver at scale. The supply deficit was not in its 6th consecutive year. China was not restricting silver exports. The COMEX had not seen its registered inventory fall to 13.5% coverage. India was not abandoning the London price benchmark. Every single structural factor that amplified the 1970 silver move exists today. And most of the factors that would moderate today's move, government stockpile reserves, new mine supply, alternative industrial materials, either do not exist or cannot be deployed on any relevant timescale. Bank of America sees silver reaching $135 on the conservative scenario, $309 on the extreme scenario. Citigroup has set a target range of $150 to $170. Gold Silver's Alan Hibbard projects above $100 as supply deficits deepen. These forecasts were made before stagflation was officially confirmed this week, before the presidential proclamation invoking national security law over silver imports was fully understood, before China tightened export controls for a further 2 years, before the COMEX registered inventory fell to 13.5% coverage. Every data point that has emerged this week makes those targets look more likely, not less. Silver at $75 to $77 today is sitting in the middle of the most constructive macro environment for the metal in the last 50 years. Stagflation confirmed, strategic stockpile empty, supply deficit in its 6th year, industrial demand from every direction. Government after government recognizing silver as a strategic national security asset. The 1970s, investors who recognized stagflation early and positioned in silver multiplied their wealth 30 times over a decade. The early cycle investors who understood the structural silver story in 2020 watched silver go from $11 to $121. The people who understand what has been confirmed this week, stagflation official, U.S. stockpile at 0, and who are positioned in physical silver right now, are the people who will look back at April 2026 the way the 1970s investors look back at 1972. As the moment when everything was visible and the price was still giving you the chance to act. This is the Bullion Rabbi. Stay sharp, stay informed, and protect what is yours.